What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we break down dividend investing, baby. So if you're excited for today's video, make sure you like the video, subscribe to the channel, and turn on the bell notifications for all future uploads. Now, if you've been along with the Fridge Financials channel for the longest time, you would know that myself used to be an active dividend investor. I used to love dividend investing. I got payouts like every single month. I had a portfolio that was bringing me about $1,000 a year just in dividend payouts by itself. And I kind of broke off of that, went more into the growth, into the ETF with investing and everything else and selling options as a way of making more money than just getting paid out in dividends. So in today's video, thanks to the members in After Hours, we're making a dividend investing video, what it is, how it works, what a REIT is, because those different types of dividends like REITs. You also have YieldMax ETFs, which is one of the hot topics that people are talking about these days as well. So we're going to kind of cover all of that and with my knowledge in dividend investing here. So as we'll take a look on my screen, first things first, if you're not aware about how dividends work, dividends, which you'll see here, dividend and a yield, basically is a payout to the shareholders for owning stock in the company. So with a company like Verizon, which doesn't have as much growth compared to like Nvidia or Google or Tesla, they want to attract shareholders in other ways. And the way that you can attract shareholders to bring their money to the table and say, hey, I want to put money into Verizon Communications so you can grow, you can make it bigger and better, is saying, hey, if you put your money with us and Verizon, we will pay you out some amount for every share that you own. So basically, it's having, when you have leftover cash available, you could be able to use that money to then give to the shareholders, give back to them, so that way they keep their money invested with your company. Now, what you will see here is you have a forward dividend and a yield. Now, again, what this basically is telling you here is that for every share of Verizon that you own, you will get $2.71. Now, this is not per day or per week or per month. This is every year. So you get about a 6.16% return on every share that you get just in a dividend payout per year. And they pay out the dividends every quarter. So again, take 271, divide that into 4, and that'll give you how much you get paid per quarter for every share of Verizon that you own. All right. Now, the nice thing about dividend investing, and especially in this crazy market times with the economy doing who knows what, and Fridge Financials trying to figure out all the different aspects of life right now with the economy, dividend investors and dividend companies like Verizon, like AT&T, like Procter & Gamble and Johnson & Johnson, these companies thrive in uncertain markets here. The reason why is because, if I'm an investor and I'm not sure if the market will go up or the market will go down, or we have a recession, or we have this, or we have that, or whatever the case may be, I would like to at least get some sort of payout for my shares. So being able to get 6% on my shares with Verizon Communications, for example, is where people will flock to in times of uncertainty. Because at least you're guaranteed, quote unquote guaranteed, a payout as a dividend, and you can get some sort of return on your assets when the markets might be going down. So with SPY being down, Verizon is up, believe it or not. SPY, I know, is down for the year, and Verizon is up 10%. We could take a look at, say, Johnson & Johnson, which I know is a pretty good one as well for dividends and everything. I don't know what they're up for the year. They're up 13% for the year. 13% for the year already is Johnson & Johnson. They're a very, very well-known dividend-paying company, as you will see right here. They pay a 3.03% dividend compared to Verizon. It's a little bit less money, but you made 13% this year, and SPY is down negative for the year already. Another one is Procter & Gamble, which I wouldn't doubt would be up again in these years. Maybe, depending on how their earnings, if they had any earnings reports or anything of that nature. Still being down 0.57% compared to the S&P being down over that. I don't even know what it's at. Let me take a look. Let's take a look. Why not? Let's pull it up. Down 3.64%. Procter & Gamble, Verizon. I'm trying to think about other ones. I know AT&T is a good one. Just ticker symbol T. That one's had a run up for whatever reason this year. It's been amazing. Up 18.66% and pays a good dividend as well. I'm trying to think about other ones that are pretty good dividend payers. I think I know Lockheed Martin does a pretty good one usually. See how they do. Their beta is really, really small. They're down, but it looks like because of earnings, looks like they had like an absolute, they had an absolute travesty here. Not a good example. But so here's the idea. Let's go back to Verizon, for example, right? So what happens usually is when you start to see this market uncertainty and people start to panic and to freak out and they're not sure and they're pulling their money, they're selling off this, they're doing this and that and this and that, they flood to these safe haven stocks, these safer investments to look at in times of uncertainty, right? So Verizon Communications is an example of where money will go to because, again, you're going to be getting something back. So even if Verizon for the rest of the year trades flat and you get no extra return for the year, you'll still make about 6% on dividend payouts, which is cash flow, which people like because you can use that. You could buy other companies, you could buy back into Verizon, you can do whatever it is you want, but you're guaranteed to make 6% if Verizon trades flat. Obviously, if Verizon's down for the year, it offsets your losses a little bit, right? And if Verizon's up for the rest of the year, it increases your gains, right? And the nice thing is, which is a very interesting thing to consider as well, is that they have what's called this beta value. Now, beta basically is a measurement of saying how much it moves with the overall stock market. 1 is the stock market. Below 1 means it moves a lot less. Above 1 means it moves a lot more. So as you'll see, Verizon's beta from the 5-year and the monthly here you're looking at is 0.4. So it's moving at less than half of how the market goes. Now, there's good things and there's bad things with it. The good thing is if the market comes down a crap ton, like 3%, 4%, we've had that correction territory, Verizon doesn't move as much. So your losses are limited because these kind of companies like Verizon, like Johnson & Johnson, like Procter & Gamble, they all have this low beta value. So they don't move as much with the stock market as a whole, I should say. They don't move as much with the stock as a whole compared to the entire market, right? So here's the thing to consider. In volatile times, when the market's uncertain, there's fear, uncertainty, doubt, the FUD is here, it's real and everything else, people will come to these companies because there's a lot less risk. That doesn't move as much compared to the regular market or the growth stocks, which the growth stocks have a high beta for a reason because they're expected to move more than the market, like Nvidia, even like Apple, Google, Tesla, you name it. Those growth companies have a higher beta because they're supposed to move more with the market. They're going to move more than the actual market itself. So you have less risk here because it moves a lot less, and you also get a little bit of a repayment back for owning the stock, 3.03% for a year just in dividends by itself. That makes sense. You're limiting your risk. It's not going to move as much, and you get dividend payouts while the stock market figures out where it wants to go. So in these kind of like correction markets, the recessions, the bear markets, I'm not saying we're in any of those. Obviously, we had a correction, but I'm not saying recession or bear market just yet, obviously. But you'll see more money flow into these kind of companies because they like the passive income. They like the dividends. They like the less moves of things. You're still invested in the market, but you're reducing your risk significantly. So people like to do that in times of uncertainty. Obviously, the downside, when the market rallies and there's a huge upside, since the beta is so small, it won't move as much. So if S&P goes up 1%, maybe Johnson & Johnson goes up 50% or 0.5%, I should say, right? Maybe it goes up only half of the amount, maybe a little bit less, right? So that's the thing to understand is that in times of uncertainty, a lot of money goes into these dividend companies because people are locking in those gains. They want to lock in that nice dividend potentially as a dividend yield, and they also want to reduce their risk. So that's kind of the basics behind it. Now, with dividend companies like Verizon, okay, there were things that I used to love to look for in dividend companies. I'm going to break down what I like to look for and how I like to look at it and what really helps out. And also give you a nice little list of other ones here that I also forgot about, like Altria, like Pfizer, like AbbVie, like all those different ones here. So what you'll see here on Seeking Alpha is they give you a lot of information here about their dividend summary. And now this to me is very, very important. Okay, because it allows me to know what's happening, how it's working, and where the company's going to be going here. So first thing, dividend yield is pretty high. 6.16% is a pretty high dividend payout. And just so we're all on the same page about dividends, the higher the yield, the less movement in the green you're actually going to get. You're not going to get as much probably movement because as the stock price falls, the dividend yield goes up. As the stock increases, the dividend yield goes down. Okay, that also goes with like bond markets, which I'll do a whole different video on in this case. But that's kind of what happens. So when the stock price is falling, the dividend yield goes up a lot more, and vice versa. And so it tells you what the annual payout is. Payout ratio to me is very important for dividends because it tells you how much of their cash they're actually paying out. I have seen companies that have paid out over 100% as a payout ratio. They're giving out more money than they're bringing in. That is a huge red flag for me. So having a payout ratio like 50 to 60%, I think is pretty good. Having a 5-year growth rate. Now, a lot of companies that people like to invest money into for dividends is ones that continue to grow the dividend. That means their companies are growing. They're giving more money back to the shareholders. You're basically getting a raise for doing absolutely nothing. So a 1.97% 5-year growth rate to me isn't that attractive. Again, Verizon doesn't move as much, so you're not really seeing as much growth compared to other companies, for example. But I like this dividend growth rate of 20 years. That means that they have grown their dividend for the last 20 years. So every time they announce a dividend, it has grown for 20 straight years. That to me is what I love. And you can look at the dividend history here and you can take a look and see how it shows you. Look at this. You are only getting raises with Verizon since way back in the year 2000. Look at these nice little uptrends here, right? In 2000, you're making 35 cents per share. Now you're making, 68 cents per share. That's amazing, right? So those are some really important things that I like to look for as you look at more and more companies. Altria is a very, very famous one as well. Altria focuses on tobaccos, and it's almost like what's called a sin stock for that reason, essentially. But if you take a look at Altria, you can go over to the dividends here. You go over to their scorecard. Very high dividend yield. Payout ratio is still less than 100, which I think is really good because you want to give out more money than you have coming in. 4% growth over the last 5 years, but they've been growing their dividend for 55 years. That is amazing, right? If you take a look at their history, take a look at this chart. Whew. Look at all of this. All the way back since 1989-ish, essentially, or even probably more than that, maybe even farther than that. I don't even know. But I mean, look at the growth. Look at the trajectory we're looking at for Altria, right? So the idea behind dividend investing, again, is to not only have a company that's growing their dividend, you don't want them to cut their dividend. I wonder if Walgreens is on here. Oh, yeah. And here's the risk with dividends, because not all dividends are guaranteed. Oh, they don't even pay. Oh, look at that. They don't have a scorecard anymore. Take a look at their history. Walgreens was one of the best known dividend paying companies of all time. One of the best ones. They've been paying it out since when they first started. And take a look at what happens here. Dividend cuts. They brought it down because why? If you take a look at their stock, down 46.63% on the year. So when the stock price falls, the dividends go up. But if they can't rebound the stock, they're paying out more than they can actually afford to. And Walgreens is now going private, I believe. I believe they got bought out recently. So just because a company's been doing dividends for 50 plus years does not guarantee it's going to be locked in for life, right? But it's a good investment. It's a good bet to think about when you're looking at dividend companies. Like Johnson & Johnson's another good one I know of. 62 years dividend growth, payout ratio less than 50%, 5.47% growth rate, which is absolutely amazing. And again, taking a look at these charts, just look at that. Just straight up, just raises on top of raises on top of raises. Very, very interesting looking at for a company here as a result. So this is the idea behind dividends, right? You're paying this money out to shareholders, right? Now we're going to take kind of a different approach. And there's two other things to look at there that are, one's a more recent hot topic. The other one has been around for many years. The first one is what's called a REIT. And I pulled up Investopedia because REITs have certain rules and regulations they got to follow, which I don't remember. REIT stands for Real Estate Investment Trust. Basically what it is that you are investing into these kind of companies that basically give you exposure to real estate without having to put up thousands and thousands and thousands of dollars into real estate, right? So it kind of breaks down what it really is here. Again, without having to buy, manage, or finance properties themselves, there are laws that go with it for real estate. The laws are right here. So to qualify as a REIT, a company must meet several requirements set by the IRS. Makes sense? They must invest at least 75% of their assets in real estate, cash, or treasuries. Okay. Derive at least 75% of gross income from rent, interest on mortgages that finance real estate or real estate sales. So basically what these companies do is they come up with these real estate properties, this land, they're leasing, and they lease it out and they collect rent. And their rent's the ones that they're going to be collecting, and they use that money to pay out to the shareholders. Now, the one thing that's different about regular stocks compared to REITs is that they have to pay out 90% of their taxable income to their shareholders. So you know how I said their payout ratio for like Johnson & Johnson was 50%? REITs are a lot higher because they have to pay out almost all of their taxable income to shareholders through dividends. So huge difference there is that a lot of their profits that they get, they pay back in to their shareholders through a dividend. Now, some REITs do monthly, some of them do quarterly, some of them, I don't think any of them do weekly, but mostly it's monthly and quarterly. And one of the most famous ones that everybody might know about is Realty Income. Ticker symbol is O. And I know that 2040 for watching this. I know you love Realty Income here. So I'm taking a look at Realty Income. Here's their scorecard here. Again, their payout ratio is high again because they have to pay out 90% of their taxable income. That does not mean they have other income that's also there as well. That's why it's a little bit less. They have a high dividend yield to make it attractive for investors, but they don't tend to really grow their dividend, right? 0 years of dividend growth rate. This one pays out monthly. So every month you're getting paid out 27 cents per share. So if you got 100 shares, you're making $27 a month just in dividends paid out every single month. Now, Realty Income is a very, very well-known one, and here's why. Realty Income has so many properties, and you might recognize a lot of them through their top 20 clients. 7-Eleven, Dollar Tree, Walgreens, LOL, we just looked at that one. Dollar Tree, I don't know why that's there twice. I think they mean Dollar General, maybe. Wynn Resorts, casinos, fitness, FedEx, BJ's, CVS Pharmacy, Tesco, Tractor Supply, LA Fitness, Home Depot, AMC, Walmart, Sam's Club. Like, they have so many different properties they're looking at, and they have 98.7% portfolio occupancy. So they are renting out 98% of their real estate. And if you look back at their overall portfolio here, let's see what they say here. This comes out with the dividends, consecutive monthly dividends declared, 656 consecutive monthly dividends declared. There was a thing that said how many properties they have. I don't know if they have it here or not. Here we go. 15,000 properties under Realty Income. 15,000. If you want to get into real estate without having to buy real estate, these guys are a company that might be the one for you. Obviously not financial advice, but so REITs have a little bit different perspectives. They're in different regulations and restrictions compared to companies like Johnson & Johnson, for example. A little bit of a different aspect because this is just an individual company that takes the money and they invest it to grow their business. Realty Income builds their portfolio, but they have to pay out a lot of their money back to the shareholders in dividends every single month. Now, the last one that is one of the more popular ones is what's called a YieldMax ETF. So YieldMax ETFs are a recently launched product line, launched through a collaboration with Tidal Investments and Zega Financial. And basically, you might know ones based off of like Tesla and MicroStrategy and everything else here. And basically, what the idea is behind it is that they sell options and they buy options against the stock that they are focusing on. So, for example, like Tesla, like MicroStrategy, and anything else you can think of that might have this YieldMax ETF. So at the core of these funds is the idea of taking the price volatility of an underlying stock or set of stocks and use a strategy known as call credit spreads to convert the volatility into high level of income, modest participation in price upside, and some degree of downside protection. Selling options, passive income. Buying options also creates passive income as a result. Now, what you'll see here is that how they're built up is about 80%, maybe give or take more or less, is in U.S. Treasury bills. These are basically like bonds that you're investing, that basically you're doing IOUs to the government. The government says, hey, give us some money, we'll pay you back plus interest. So Treasury bills is the most common one that people usually hear about. They're called T-bills usually. And the idea is that they have that passive income because the government pays you back interest on top of the money that you are loaning them, which is really, really good. And then they also do options contracts as well. So again, YieldMax buys call options to act as a surrogate for owning the stock. These are out of the money call options, which means that the fund can benefit from some future price appreciation in the target stock. The other option is the sale of a call option, also known as a covered call. Covered calls, essentially saying, hey, it'll have upside, but not too much upside, and you get premiums on top of that. So if the stock doesn't move up too much, then you also collect that premium on top of your bought call option that also gives you more value. And basically what they do in exchange for limiting the profit potential of the stock is they pay out their profits into the shareholders, which you'll see. This is basically why YieldMax ETFs like MicroStrategy, like Tesla, they have very high dividend yields. For this reason, they're taking these profits from their options trades and their treasury bills, and they're paying them out to shareholders. Because why would you want to invest in a Tesla YieldMax ETF that is limiting the upside of the stock when I can just go out and buy Tesla stock? You need some incentive to get shareholders, and the way to do it is through dividend payouts. So they take these options they sell and buy, and they use those profits to then pay out their shareholders in a form of a dividend. So that's kind of what the idea is behind a YieldMax ETF. They do have expense ratios you got to pay for, are basically baked into when you're buying on brokerages and everything else. And again, they're on things like NVIDIA, Microsoft, Tesla, Meta, MicroStrategy. They're all there for you. And they have very, very high yields. For example, I know MSTY. I know New Fish Big Pond is a huge lover of MSTY, and I don't blame him for it because it's a very good dividend payout. Let me see. Oh, I don't think you'll find it on here. It says this is the yield here. Let me go to the Google. Let me go to MSTY dividend history, because the NASDAQ actually tells you what the dividend payout was last time. So right now their dividend yield is 76%, which is obviously huge, right? And so basically what the idea behind these income ETF strategies is that you hope that MSTR, the MicroStrategy, will go up, but not too much over time. If you're bullish on it, like crypto, like New Fish Big Pond is, obviously you're going to be bullish on it, but this gives you some income as you go. You get $16 per share of YieldMax MicroStrategy here, and I think each one is trading at like $20 or something like that. What was it trading at? Let me see. Yeah, $21. You're getting basically almost a 100% payout over the year if you hold the MicroStrategy's YieldMax ETF. Unbelievable, right? It's unbelievable. And again, this is the new way of investing, where you're buying into basically holding the shares that go with MicroStrategy, but then they use options as ways to reduce risk from the upside, from the downside, and they use that money to pay out the shareholders. And you can take a look at MicroStrategy's yield ETF portfolio here and how they distribute it, and it's really, really cool, actually. It gives you the breakdown of all the dividends they've paid out. And this is what I wanted to kind of show you is the holdings. So what you will see here, I wonder if you could sort this here. I tried to download it. It didn't really work out that well. I wonder if I can refresh and see. Holdings. Treasury bonds. Treasury bonds. Treasury bonds. As you will see, 65% there. Another 8% there. Another 8% here. 4% there. So you're looking at well over 80% just in treasury bonds by themselves. But again, they're paying out about 3%, 3.875% on these treasury bonds here. But take a look at these other things. Also, they have a lot of cash right now. The cash is what they're sitting on. I read that as a treasury note. It is not. It is cash they're holding right now. So 8% bond here, 8% bond there, 4% here, 4% there, 3%. So they have a lot of bonds that usually are used as passive income. What you could take a look at is, take a look at this. Just by shares, this is them selling put options on MSTR. So they're selling put options on SCR because the shares are negative. They're basically saying, hey, don't go below a certain strike price by April 17th. Don't go below 260 April 17th. Don't go below that's a cover call option right there. And again, the only reason why I know about that is because they're negative, right? You also have positive ones here, as you will see. This one is a call option they bought, so those are positive shares they're buying in that one. So basically what they're doing is they're using call options that are bought and call options that are sold to then use that money they make from their holdings to then give out to the investors, which is why the dividend yields are all over the place, right? They're not always exactly accurate in terms of they're not consistent, right? So if you take a look at MSTY's history again, you'll see the dividends fluctuate. 227, 202, 137, 308. So it's not consistent, but it's a very good yield that you could potentially get into. And again, if you're bullish on MicroStrategy, if you're bullish on Tesla, if you're bullish on Nvidia, these are some good ways to get that passive income as well. So that is basically the ideas behind dividends. Hopefully gives you a little bit of an insight into how dividends, A, how they work, B, what a REIT is, C, what a YieldMax is, and anything else under the sun that involves dividends. If you made this fun, the video, thank you so much for watching. Make sure you like the video and subscribe to the channel as per usual. I hope you're making money in the market, whether it's through YieldMax dividends, through REIT dividends like Realty Income, or just through your normal standard dividend stock companies like Verizon. Thank you guys so much, and as always, I will see you guys in the next video.